8 portfolios in our first quarter challenge posted double-digit returns, easily beating the S&P 500 and its loss of almost 6% during the quarter. In fact, one portfolio returned 38% in that time. Hey Bowtie Nation, Joseph Hogue here, and the results of our Q1 Bowtie Nation Portfolio Challenge on StockCard. It was a lot of fun seeing the portfolios you created, and we learned a lot in the process. In this video, we'll look at the top 3 portfolios, what they did to beat the market, and what we can learn from each. I'll then show you the strategy Wall Street ETFs and hedge funds use to beat the market and why it works. You know we can't get started though without that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'll leave a link to StockCard in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the list. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation, that's all one word in lowercase, for an exclusive discount beyond the free trial. We'll click through the portfolios here and we can see this portfolio has gone even further, a gain of 41%, 33% over the S&P 500. And if we scroll down, we can see he started the portfolio on March 14th, just before that big market rebound on the 16th when the Fed started increasing interest rates. He bought a few of these growth stocks that have really rebounded, 32% for Snowflake, 27% for Twilio, and then some of these Direxion daily bull market funds, these 3X funds. We can look at these. And what these are is these are ETFs, exchange traded funds that track things like the Dow Jones, the S&P 500, but they do it on a leveraged basis, making 3 times the return on those indexes. Now, that market timing is something we've been talking about on the channel over the last couple of months, leading up to that interest rate hike by the Fed on March 16th. It was a classic sell the rumor, buy the news behavior where investors sold out of stocks on that fear of higher rates leading up to the first rate hike. In a sense, it's like timing the market gone bad, where investors sell out in anticipation of something, then realize when that something gets here, in this case those higher rates, that it isn't so bad and they have to get back into stocks as the market rallies. So this one was very much a play on that market sentiment and the investor behavior, and very well done by Vish. On this next fund, by Smart Investing, up 38% since he started the portfolio, 38% above the S&P 500, and you can see it's a very simple strategy. He shorted 2 stocks, each selling short and then closing the position within the same day, so much more of a day trading strategy. Now, EPAM Systems here, ticker EPAM, had released some news that it was withdrawing outlook or delaying some of his financial reports on the Ukraine invasion. So this was a bad news-based short. Dodge Nest, for its part, announced that it would issue shares to some institutional investors, so diluting their current shareholders, and then it fell on that news. And that third portfolio, Sophia here, earned 21.6%, and almost 20% over the S&P 500 during the period. And you can see she started early February, so even before the market started to rally. And I like this portfolio here. It's a buy and hold strategy, so based on finding those strong long-term investments. And again, all of these were before the big market rally, so the returns are quality here. There's some really good returns, even when the rest of the market was plunging. Silvergate Capital. Silvergate is a bank holding company, so going off the fact that banks should do well as interest rates rise this year. We also had Lithium Americas Corporation, ticker LAC. It's a company that we covered here on the channel in early March, but it looks like she was already in that stock. Now, Build-A-Bear Workshop, honestly, I didn't even know this company was traded, so I'll have to check that out. But Bakkt Holdings, this is a crypto platform that has been getting a lot of press lately. And what's interesting here is it has done so much better than the other platforms like Coinbase and even crypto prices like Bitcoin. Again, congratulations to everyone that participated in the portfolio challenge. And I think there are some great lessons here we can learn about investing. First, you notice none of these portfolios had dozens of stocks. In fact, one had 6, another 5, and the other only 2 stocks. Nation, I see way too many investors just chasing every hot stock tip they get, and honestly, I take some of the blame for that as well. Folks, you've got to understand, investing has become an entertainment industry. You watch CNBC or some of these other YouTube channels, and And it's no longer about good analysis, but about shocking you with sensational promises and those dreams of becoming rich overnight. You get information overload at 50 stock picks a day and that fear of missing out if you're not investing in every single one. It's why I try to spend just as much time talking about the why of investing, how to invest, rather than just what to buy. But even I feel like a slave to that monster sometimes that just needs to find that next stock to buy. But chasing all these stocks, it's just going to limit any returns you actually make on a few. If you had 50 stocks in your portfolio, a few of those could double in value, just blow the doors off the market, but the portfolio is so spread out that it's going to barely move the needle on your overall wealth. And this is also why I recommend the core satellite strategy of investing. Putting half of your money in maybe 3 to 5 ETFs, those broad-based exchange-traded funds that are going to lower your risk and get you that market return. Then you invest the rest of your money in just a very limited number, maybe 8 to 15 individual stocks. Because you're limited to how many stocks you can buy, you can only invest in your highest conviction targets, the companies you feel so strongly about that they're going to be good investments. That's going to focus your returns on just those few and give you the chance to outperform instead of spreading yourself out across too many stocks. Another idea we saw here is that investing is just as much about market direction as it is about picking individual stocks. Let me tell you, it is so much easier just to follow those big market trends and the investor behaviors, riding those for higher returns, than it is trying to pick individual stocks from the 5,000 plus trading in the market. All you out there in the nation know this is my favorite way to invest, starting with that big picture. What are the forces driving the entire market? Then using that to narrow down our focus into individual sectors or groups of stock. And we actually see both of these ways to beat the market when we look at hedge funds and a lot of exchange-traded funds. And funds are always going to be compared against their index. So did their returns beat the S&P 500 or small cap stocks or bonds or whatever group of stocks the fund is targeting? So what a lot of successful fund managers do, and you never hear about this, but this is the dirty little secret on Wall Street, is they hug the index, investing heavily in the index itself, whether that's the S&P 500 or the NASDAQ. They basically just invest in that group of stocks, so they know they're going to get those market returns with the most of their fund assets. Then they overweight just a few stocks, usually less than 10 or 20 stocks within the index. They're going to buy more of those for that bet on the companies that they like the most. That gives them the opportunity to outperform the index on those few stock picks. Beyond this, they might also make those directional bets on the market, so shifting some of their fund assets into cash at different times, all to get that 2 or 3% return above the index. It's going to put them at the top of their fund rankings. Again, you don't hear about this, but it's actually the strategy nearly all fund managers use to guarantee they don't underperform their index by too much, but also have that chance to produce a little higher returns and justify those fees. We'll be contacting the top portfolios to claim their prizes soon. Check out the 2021 portfolio on StockCard or click on the video to the right to see the 11 cheapest stocks in every sector, the best value stocks in the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.